the 2-year look-back trap that steals your Medicare savings. The government doesn't advertise this. Your advisor may not mention it. And by the time you find out, it's already costing you thousands. Medicare can charge you more every month based on income from 2 years ago. No better benefits, just a higher bill. If you're between 60 and 63, you have a small closing window to prevent it from snowballing once you hit Medicare. One busy tax year, and poof, $4,000 to $10,000 can vanish with zero change in coverage. Today, I'll decode IRMAA in plain English, show legal ways to shrink it, and the exact form to fix it if it already hit. Stick around for 3 moves that can cut IRMAA in half, or erase it. First, we decode the look back, so it stops biting you. The trap exposed, IRMAA and the time warp. If you remember nothing else, remember this. IRMAA is a surcharge tacked onto Medicare Part B and Part D when your modified adjusted gross income from 2 years ago crosses certain thresholds. You don't get better benefits. You just pay more because of how your past income reads on paper. Why does it exist? The system makes higher earners contribute more toward program costs. Fair or not, it's the rule. So instead of guessing, let's make the math work for you. Start with MAGI. For Medicare, Social Security uses the IRS data it receives. Your adjusted gross income, AGI, plus tax-exempt interest. That's it for IRMAA purposes. AGI from Form 104 line 11, plus whatever shows as tax-exempt interest. The number itself isn't printed as MAGI on your return. You calculate it from lines that already exist. Now, the sliding scale. Each year, there are tiers. If you're under the base threshold, you pay the standard Part B premium and your normal Part D premium. Cross a tier, even by $1, and you owe an income-related monthly adjustment amount for the whole calendar year. That's the cliff most people don't see coming. It's not gradual, it's brackets. The higher the bracket, the higher the monthly add-on. Here's the sting. Your coverage doesn't improve. IRMAA is simply a pricing adjustment. Your neighbor with the same plan might pay far less because they stayed under the threshold while your tax return showed a spike. What pushes people over? The list is longer than you think. Required minimum distributions from traditional IRAs and 401k big Roth conversions in a single-year capital gains from selling stock, a rental, or a second home, mutually timed mutual fund distributions in December severance, deferred comp payouts, or exercise stock options, one-time windfalls that look like salary on your return. Each of those stacks onto AGI, and some add tax-exempt interest on top. The thing most people miss is timing. When that income shows up on your tax return, Medicare won't react this year. It reacts later, after the IRS transmits the data and Social Security recalculates your premiums. This clicked for me when I saw 2 neighbors with identical doctors, prescriptions, and plans paying wildly different bills. One did a large December Roth conversion for just a little more. 2 years later, they both got letters, one with the standard rate, the other with an extra few hundred per month. No extra benefit, just higher premiums because the return crossed the line. If you want a mental model, think cliffs with a ruler. First measure where your MAGI sits relative to the nearest threshold. Then build a buffer. Target staying comfortably under, not right on the line. Because $1 over means the higher bracket for the full year. Let me show you exactly how this can hit. Say your AGI is $95,000 and you hold tax-exempt municipal bonds generating $6,000 interest. Your Medicare MAGI is $101,000, not $95,000, because that interest adds back. If the base threshold is $109,000 for singles or $218,000 for joint, that year you're safe. But a $7,000 mutual fund capital gain at year-end bumps MAGI to $108,000, and now you've crossed. You'll pay the IRMAA add-on next cycle. The reason this feels unfair is the time warp. Medicare uses IRS data from 2 years prior because it's the latest verified return when premiums are set. So your 2026 premiums are driven by your 2024 MAGI. Retired in 2025, Medicare still sees your 2024 income until you prove otherwise. Another nuance, IRMAA applies to both Part B and Part D. Same brackets, separate add-ons. Cross a tier, and you can see an increase on doctor coverage and on prescriptions. That's how small missteps turn into four-figure annual surprises. Common mistakes to avoid: stacking conversions, RMDs, and capital gains in the same year, taking large withdrawals in December with no time to offset, forgetting tax-exempt interest counts toward MAGI landing on the line instead of under it, ignoring filing status changes. Married versus single thresholds differ. Here's a quick one you can do this week. Pull last year's return. Find your AGI, line 11, and add tax-exempt interest, line 2A. That's your Medicare MAGI. Compare it to the current IRMAA thresholds for your filing status. If you're within a few $1,000s, set a hard buffer and plan any extra income, withdrawals, sales, conversions accordingly. And yes, there's a legal reset button when your income truly drops because of a qualifying life event like retirement or reduced work. It's called Form SSA-44, and it lets you ask Social Security to use more recent income instead of the old return. We'll walk through that soon. Once you grasp the why and the what, the how gets simple. Map your MAGI, respect the cliffs, avoid stacking, and time one-time income. Now here's where most people mess up: the government's 2-year time warp built into the system that quietly turns a small December move into a hidden, bigger bill later. The 2-year look back, how it actually hits you. Here's the mechanic under the hood. Social Security doesn't guess your income. They use the most recent verified IRS data they have when they set next year's premiums. That's your tax return from 2 years ago. So, premiums in 2026 are based on your 2024 modified adjusted gross income. It's clean, it's consistent, and it's why the surprise shows up late. Think of it as a conveyor belt. You file taxes, the IRS processes, then Social Security pulls those numbers, calculates your IRMAA tier, and sends a letter that changes your Part B and possibly Part D premiums for the next calendar year. You can't negotiate the past. You plan the present. So the next letter is boring. Let's put dates and dollars to it. Say in 2024, you did a $30,000 Roth conversion, sold a winning mutual fund that distributed a year-end capital gain, and took your first required minimum distribution. Your 2024 MAGI jumps. In 2025, you feel the higher tax bill. Then late 2025, Social Security mails a notice that your 2026 Medicare premiums will be higher. The cause is 2 years back, which is why it feels disconnected. It isn't. It's just delayed. Now, annual reassessment matters. IRMAA isn't permanent. Each fall, they recheck your income tier using the latest available return. If your 2025 MAGI drops below a threshold, your 2027 premiums can drop too. That's why I say one spike is a 1-year Medicare problem, but the look back makes the pain land later. The fix is planning the slope of your income, not just this year's number. Here's where most people mess up: bracket cliffs. These are not gradual ramps. They're ledges. If your MAGI is $1 over the threshold, you're in the higher bracket for the full year. That means 12 months of higher Part B premiums and the Part D add-on if you have drug coverage. No extra benefits, just a bigger bill. So close isn't a strategy. Under is. Quick story. A client took a small $4,000 IRA withdrawal in December for home repairs. It's stacked on top of a mutual fund capital gain they didn't realize had hit earlier that month. 2 years later, a letter showed up. higher premiums for both spouses for the whole year. The $4,000 move cost over $1,000 in IRMAA across Part B and D combined. If they'd split $2,000 into January, they would have stayed under the line. Timing, not size, was the trap. Before we continue, you need to understand what resets the look back midstream. If you had a qualifying life-changing event, retirement, work reduction, divorce, death of a spouse, loss of income-producing property, you can ask Social Security to use your more recent income instead of that 2-year-old return. That's Form SSA-44. It's the legal reset button. Almost nobody files, and it can shrink or eliminate IRMAA going forward. We'll cover it in detail next. Another nuance people miss. The look back applies to both Part B and Part D. Same income brackets, separate surcharges. So 1 year's income spike can double punch you. Higher doctor coverage premiums and a prescription add-on. If you only look at Part B, you'll underestimate the total hit. Okay, let's make this practical. Pull a calendar and label 3 years: the tax year, the Medicare year that follows 2 years later, and the year in between when you still have time to adjust the next cycle. For example, 2024, income decisions that set IRMAA for 2026-2025. You can still shape 2027 by smoothing 2025 income 2026. You're living with 2024's decisions. No surprises if you planned this 3-lane view stops the whiplash. You'll know which year you're influencing and which year you're enduring. Common delayed triggers. December mutual fund distributions landing when you're already near a threshold, 1 large Roth conversion instead of spreading conversions across years, irregular pension lump sums, or deferred comp payouts, selling a rental or second home in a single calendar year, taking RMDs, and realizing capital gains in the same year by accident. So what do you do right now? Build a cliff cushion. If the threshold for your filing status is, say, $218,000, aim to cap your MAGI several thousand below it. Don't thread the needle. Then, install a Q4 checkpoint. In September and again in November, tally year-to-date income, estimate dividends and capital gains, and decide whether to shift income into January, harvest tax losses, or donate via qualified charitable distributions if you're eligible. 2 15-minute checks can save a year of higher premiums. One more psychological trap. People assume, I'll just pay this 1 year and be done. Maybe, but if you don't change the pattern, the conveyor belt keeps delivering letters. The solution is smoothing. Reduce the size of any single year spikes, spread elective income across years, and keep your MAGI predictable. Once you do that, the 2-year look back becomes a non-event because every year looks safe. Now that you see how the time warp really works, let's hit the reset button you can legally use when your income truly drops. It's simple paperwork, but the timing, documentation, and estimate matter. The real cost, front-loaded, what IRMAA can take. Let's put real dollars on this. Start with the base. In 2026, most people pay the standard Part B premium of about $202.90 per month, and whatever their Part D plan costs. IRMAA stacks on top. Same coverage, higher bill, 2 separate surcharges, 1 for Part B, 1 for Part D. That's why the pain feels bigger than expected. 2 dials turn at once. Now, the tiers. IRMAA is bracketed. If your 2 years ago MAGI is under the base threshold for your filing status, you pay standard rates. Cross the first tier, and your Part B jumps by a monthly add-on, and your Part D gets its own monthly add-on. Climb tiers, and both add-ons climb too. For many retirees, that translates to roughly $1,000 to $2,000 more per person per year at the lower tiers, and several thousand at higher tiers. Remember, those amounts update annually, but the structure doesn't change. Singles versus couples matters. IRMAA is assessed per person, and the brackets differ by filing status. married filing jointly has roughly double the base threshold compared to single. But here's the kicker. If one spouse dies, the survivor quickly shifts to single thresholds. Same household resources, tighter brackets. That filing status change alone can push a survivor into IRMAA even when income didn't really rise. It's a planning hazard worth addressing long before it happens. Let me show you how quickly this adds up. Say you and your spouse land in the first IRMAA tier 2 years from now. Part B might go up by around $70 to $100 per month each, and Part D by another $10 to $20 per month each. Combine them and you're out $2,000 to $3,000 after tax in that year for both of you. Bump one more tier, and you could be staring at $3,000 to $5,000 plus per year per couple. Hit a high tier, and it's a 5-figure drain across 2 people. Again, same benefits, just higher pricing. Now, bring the time warp back in. Because of the 2-year look back, you often pay for a spike long after it happened that can stretch the damage over 2 calendar years. The tax year you feel right away, then the Medicare year that arrives 2 years later. If you have a second spike the following year, say another large distribution, you can stack IRMAA years back to back. That's how one busy season turns into a multi-year budget squeeze. Opportunity cost makes it worse. Every extra dollar to premiums is a dollar not covering dental work, new lenses, a hearing aid, a home safety upgrade, or a trip to see grandkids. At $150 a month, you might shrug. Over 12 months, that's $1,800. Over 2 years, $3,600. For a couple, double that. That's a roof repair, deductible physical therapy sessions, or a high-quality pair of hearing aids you now delay. Here's a micro story. A couple's joint MAGI cleared a tier by just $200 after a late mutual fund distribution hit in December. The next IRMAA letter raised each spouse's Part B and Part D for the entire year. Total extra cost, about $1,600 combined. That's money that could have gone to a grandkid's college fund. Money that could have paid for a roof repair. Money that could have funded a trip to see family. Money that just vanished. They didn't change doctors. They didn't fill more prescriptions. They simply crossed the line by the price of a small appliance. A $200 overflow led to $1,600 out the door. If they'd known, they could have realized the distribution in January and avoided the tier. Another pattern I see, front-loading. The first IRMAA year feels like a nuisance. Then the second year arrives because you triggered 2 spikes in a row, maybe a conversion and a sale. The line item becomes normalized in your budget. That's dangerous because it masks how much control you actually have. IRMAA is not a lifetime sentence. The system rechecks annually. If you keep future MAGI under thresholds, those add-ons can drop away at the next reset. Let's talk filing status one more time, because it's critical. Married filing jointly gives you wider lanes. But if you separate or divorce, MAGI testing shifts to single thresholds for each of you. Same with widows and widowers. The moment status changes, your buffer shrinks. If you're anywhere near a threshold, now build bigger margin than you think you need. It's a gift to your future self. Quick diagnostic you can run today. List your base premiums for Part B and your plan's Part D. Look up the current IRMAA brackets for your filing status. Note the monthly add-ons for the first and second tiers. Multiply by 12 and by 2 if you're married. Feel the annualized hit. When you see the annual number, it stops being abstract. You realize a small December choice can cost a full year of surcharges for 2 people. That's why we obsess over buffers, year-end checkpoints, and not stacking income sources. The takeaway, IRMAA's cost is front-loaded in behavior, but back-loaded in time. A single year spike can create a multi-$1,000 premium bill later. with no added benefit. No, the tiers measure your distance and protect your buffer. The widow's penalty, a cruel double hit. Here's where it gets cruel for surviving spouses. When your spouse dies, your filing status shifts from married, filing jointly, to single. The threshold that protected you at roughly $218,000 suddenly drops to around $109,000. Same income, same household, but now you're tested against a tighter line and can be pushed into IRMAA without earning a dollar more. A survivor who paid standard rates as a couple can see Part B alone jump by roughly $370 per month, about $4,440 a year, before even counting the Part D add-on. This is why planning for widowhood matters now. Build bigger buffers while you're filing jointly. Steadily shift dollars to Roth, so future withdrawals don't inflate MAGI. Keep income predictable, because when one spouse dies, the survivor's financial world doesn't just shrink, it often gets more expensive. Next, we'll hit the reset button. How Form SSA-44 can lower or erase IRMAA when your income truly drops. The reset and the soft landing. Good news, if your income genuinely dropped, you don't have to keep paying for a year that no longer reflects your life. The legal reset button is Form SSA-44. It tells Social Security, use my newer, lower income instead of the 2-year-old return that triggered IRMAA. Here's why this matters. Medicare bases IRMAA on IRS data from 2 years ago because it's verified, but the rules also recognize life-changing events that reduce income. When one happens, you can request a recalculation using your current or prior year numbers. If approved, your Part B and Part D surcharges can fall or disappear, sometimes immediately. What counts as a qualifying life-changing event? The big ones: retirement or work stoppage, work reduction, fewer hours, lower pay, death of a spouse, divorce or annulment, loss of pension income, loss of income-producing property due to events beyond your control. These are in the SSA's instructions for SSA-44. They're specific, ongoing changes that reduce income. What doesn't count? General investment moves, capital gains, Roth conversions, mutual fund distributions, or selling a second home. Those are tax events, not qualifying life changes. You can still plan around them, but they don't qualify for this appeal. How the form works, step by step. First, identify the event and its date. Retirement counts the day your employment ends or your hours meaningfully drop. Second, estimate your modified adjusted gross income for the year of the event and, if asked, the next year. Keep it realistic. You're signing that estimate. Third, attach proof. For retirement or work reduction, that's typically a retirement letter, termination notice, or recent pay stubs showing the change. For a spouse's death, the death certificate. For divorce, the decree. For loss of pension income or income property, the award or loss documentation. A quick pro tip: keep your estimate conservative and consistent with your current trajectory. If you overshoot low and your actual tax return ends up higher, SSA can adjust later. If you guess too high, you might leave savings on the table now. You can also update if circumstances change. Timing. File as soon as the life-changing event occurs, and you can reasonably document the reduced income. You don't have to wait for tax season. If you already got an IRMAA letter, you can still file SSA-44 to request a reduction going forward. The sooner you submit, the sooner the recalculation can apply. Some people see adjustments within a billing cycle. Others take longer depending on workload and documentation quality. What approval changes? If SSA agrees your current or prior year income is below the threshold for your filing status, they'll adjust your IRMAA tier for both Part B and, if applicable, Part D. That lowers the monthly premium deductions taken from your Social Security benefit or your direct bill. It doesn't retroactively refund past months unless they determine those months also qualified. So speed helps. What if you're denied? Ask for reconsideration. Keep records of dates, letters, and what was submitted. Sometimes a denial simply means the documentation didn't clearly tie the event to the income drop. Tighten the paper trail. Clearer employer letters, updated pay stubs, or pension statements. You can also point to the exact qualifying event category that fits your situation. And remember, each fall, IRMAA resets based on newer IRS data. Even if the appeal fails, lower future income can still reduce next year's surcharges automatically. Now, let's talk estimating income on the form. Remember IRMAA's MAGI equals AGI plus tax-exempt interest. Build your estimate from pay you actually expect, retirement distributions you'll take, Social Security benefits, pension amounts, dividends and interest, and any known capital gains. If you'll use qualified charitable distributions from an IRA, those count toward your RMD, but don't raise AGI, which can keep your estimate lower. Document your assumptions in a simple worksheet you can show if asked. If you have the right documentation and a qualifying life-changing event, SSA approves most appeals. The mistake people make is sloppy estimates or missing proof. Get it right, and you can reduce or eliminate IRMAA going forward. Supporting docs that strengthen your case: employer retirement or separation letter with effective date, final pay stub, and a recent stub showing reduced hours or dollar pay pension reduction or cease letter award letters for Social Security if timing changed your income mix brokerage or IRA distribution plans that reflect a lower draw death certificate or divorce decree where applicable. A quick micro story. A teacher retired in June. Her 2024 MAGI, 2 years before the Medicare year in question, was high from her final contract and a payout. She filed SSA-44 with her retirement letter, a year-to-date pay stub, and a reasonable MAGI estimate showing reduced income for the appeal year. SSA recalculated using the new figure and removed her IRMAA for both Part B and Part D going forward. No special tricks, just the right form, the right proof, and a realistic estimate. Expectations. You may need to respond to follow-up questions. Keep copies of everything you submit. If approved, watch your Social Security payment or premium bill for the updated amount. Mark your calendar for the next annual reassessment. Your future tax return still drives later years. One last point. SSA-44 is for qualifying life events. If your problem was a one-time spike like a large conversion or a capital gain, we'll use other strategies to soften the hit and avoid a repeat. That's next. And don't overthink the paperwork. The form is short, the categories are clear, and with basic documentation, most retirees complete it in one sitting. One-time spikes, smart moves to soften the hit. If your IRMAA problem came from a one-time spike, you don't need a life event appeal. You need clean income design. The goal is simple: prevent a single calendar year from carrying too much MAGI, so the system can't quietly penalize you 2 years later. We'll identify the hidden culprits, spread income across years, use charitable tools that keep MAGI quiet, and add a couple of timing plays so a December surprise doesn't cost you 12 months of higher premiums. First, name the non-qualifying spikes that often trigger IRMAA letters. Large Roth conversions done all at once, big capital gains from selling stocks, funds, or a second home, sizable mutual fund distributions that appear in December, deferred comp or option exercises paid in a lump, and cashing out old annuities or CDs at maturity with unexpected interest. None of these count for the SSA-44 appeal. That's fine. We tackle them with planning. Your first lever is spreading income. Instead of a $60,000 Roth conversion in 1 year, consider 3 $20,000 conversions across 3 years. Same long-term goal, smoother MAGI. If you must sell an asset, split the sale across December and January. Half the gain lands on this year's return, half on next year's. That single split can keep you under a cliff twice. The same logic works for bonuses or consulting payments. Negotiate when they're received if you have any control. Next, charitable strategies. If you're 70 and a half or older and you give to charity anyway, use qualified charitable distributions from your IRA. QCDs count toward your RMD, but don't raise AGI, which means they don't raise the MAGI Medicare uses. That's gold when you're near a threshold. If you're not QCD eligible or you want to pre-plan, bunch 2 or 3 years of donations into a donor-advised fund during a high-income year to grab the deduction, then grant to charities over time. A deduction lowers taxable income. QCDs lower MAGI. Use the right tool for your situation. Now, timing plays. Work with the 2-year lookback instead of against it. If you know you'll need to realize income, do it in a year that won't set the Medicare year you care about. Example, you turn 63 in 2026. Any spike in 2026 sets 2028's IRMAA if you can delay the spike to early 2027 or pull some into late 2025. You might spare your first Medicare years. For folks already on Medicare, the rule of thumb is to calendar income so that no single tax year bursts through a tier. That means installing a Q3 and Q4 check. In September, estimate dividends, interest, and realized gains. In November, call your fund companies and ask about projected capital gain distributions. Adjust before December hits. Here's the second-year slide concept. IRMAA recalculates annually using that 2-year tax return. If your spike was in 2024, you'll pay higher premiums in 2026. But if you keep 2025 MAGI under the threshold, 2027 can drop back to standard. Set cash aside during the IRMAA year, so you're not forced into another large withdrawal. A simple reserve prevents a repeat. Quick wins when you're $1 over. If you discover in November you're barely above the line, look for easy MAGI reducers. QCDs if eligible. Delay optional IRA. Withdrawals into January. Harvest capital losses to offset gains. Defer a bonus if possible. Shift a small consulting invoice. If you're self-employed, tighten legitimate business expenses you were going to incur in January. Moving them forward lowers this year's AGI. The point isn't fancy maneuvers. It's nudging back under the cliff with clean, documented moves. Let me give you a simple playbook you can run in 30 minutes. 1. Write your MAGI target. Base threshold for your filing status, minus a cushion of at least $2,000. 2. Pull year-to-date income, including dividends and interest. 3. List pending items. RMDs left, expected fund distributions, planned asset sales, or conversion amounts. 4. Choose one of 3 paths. Reduce or delay income to land under, split income across December/January, or offset gains with losses or QCDs. 5. Set 2 alerts, a mid-September projection check and a mid-November lock list. After mid-November, avoid optional moves unless you've rerun the math. A quick story for context. A couple planned a $50,000 Roth conversion in December after a strong market year. Their advisor projected their fund's capital gain distribution would be $12,000 each. That extra $24,000 plus the conversion would blow past the next tier. They pivoted, converted $25,000 in late November, another $25,000 on January 3rd, and used a $10,000 QCD to satisfy part of their RMD without raising MAGI. They stayed under both years and missed the surcharge entirely. Same moves, different calendar. Common traps to avoid. Letting mutual fund distributions surprise you, stacking RMDs, conversions, and home sale gains in 1 year, assuming deductions lower MAGI the same way they lower taxes, and aiming to land right on the line. Under is a plan. On the line is a gamble. If your spike already landed, your job is to avoid a second spike and plan the slide back down. If the spike hasn't landed, use these levers now. Next, we'll build a 10-minute projection to map your IRMAA risk and install guardrails so You don't have to think about this every month. Project your IRMAA risk in 10 minutes. Let's build a fast, reliable IRMAA projection you can run anytime. Grab last year's tax return, your latest statements, and a simple notepad. 10 minutes and you'll know if you're safe, close, or over, and what to change before December. Steps 1 to 3. Gather, estimate, and map quickly. Pull your AGI from last year's Form 1040, line 11, and tax-exempt interest from line 2A. Add year-to-date income snapshots, pay stubs, pensions, Social Security, IRA distributions/RMDs, dividends, realized gains, annualized monthly withdrawals. Estimate this year's Medicare MAGI, expected AGI plus tax-exempt interest. If you don't know all numbers yet, use conservative estimates based on last year plus what's already happened. For dividends and capital gains, call fund companies or check Q4 distribution estimates. Map against current thresholds for your filing status. Write the base threshold and the first 2 IRMAA brackets. Mark where your projected MAGI lands. If you're within $2,000 to $5,000 of a line, you're too close. Build a cushion now. Step 4. Build your cliff cushion. Pick a hard buffer below the threshold, at least $2,000, preferably more. Write target MAGI cap equals threshold minus cushion. That's your guardrail. From here on, any move that pushes you past that cap needs to be delayed, split, or offset. Step 5. Install a 3-year view. Make 3 columns labeled this tax year, next tax year, and Medicare year affected. Under this tax year, list known income and elective items, conversions, sales, distributions. Under next tax year, add what you can shift or split into January. In the Medicare column, write which calendar year's premiums those choices will affect due to the 2-year lookback. This keeps you from fixing the wrong year. Step 6. Add expected RMDs and known changes. If you're at RMD age, estimate this year's and next year's RMDs using last December 31st balances and the IRS table. Note any upcoming pension changes, Social Security start dates, or filing status shifts, widowhood, or divorce. These are silent IRMAA movers. Step 7. Identify the cliff you're nearest. Circle the tightest gap. Ask, what's pushing me closest to the line? Common culprits: December fund distributions, one big IRA withdrawal, stacking conversions with RMDs, or an asset sale landing all in 1 year. Step 8. Choose a control lever. Delay. Move elective income into January to split across 2 tax years. Reduce. Trim the size of a conversion or withdrawal to stay under your cap. Offset. Harvest capital losses against gains, or if 71.5 plus. Use QCDs to satisfy part of your RMD without raising MAGI. Sequence. Cover spending from taxable accounts or Roth instead of piling onto AGI near year-end. Step 9. Create a simple 3-year income plan with guardrails. For each of the next 3 tax years, jot target MAGI cap, threshold minus cushion, planned RMD amount, and how you'll satisfy it, monthly, quarterly, or December. Roth conversion fill amount, if any, that keeps you below the cap, known distributions or sales, and whether they'll be split December/January. Step 10. Set 2 calendar checkpoints. In mid-September, run a projection check, update year-to-date income, confirm expected dividends and fund distributions, and remeasure your gap. In mid-November, run a lock check, freeze optional moves unless your numbers still show safe room. If you discover you're too close, use your levers immediately. Now you try. On your notepad, write AGI line 11 _______ tax-exempt interest line 2A ______ projected MAGI AGI plus 2 equals _______ threshold for my status. underscore 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 my cushion. $2,000 plus my cap. Threshold minus cushion equals underscore 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 current gap to cap. Underscore 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 underscore. If that gap is slim, pick one change today. Delay income, reduce a planned withdrawal, offset gains, or line up a QCD. Small adjustments now beat a full year of higher premiums later. The thing most people miss is that close is not a plan. Under is a plan. That's why we set a cap and automate 2 quick checks. 10 minutes today can save 12 months of surcharges 2 years from now. Once you've got your map, the next step is trimming MAGI with simple, legal moves that don't hurt your lifestyle. That's where we're headed next. MAGI trim. Simple, legal ways to lower it. Now that you've mapped your cap, let's trim MAGI without cutting your lifestyle. Think of these as quiet levers. Each one lowers the number Medicare cares about, keeps you under the cliff, and often helps your tax return too. First up, QCDs after age 70 and a half. If you're charitably inclined, this is the cleanest move. A qualified charitable distribution sends IRA dollars directly to a qualified charity. It counts toward your RMD but never hits AGI, which means it doesn't raise Medicare MAGI. In 2025, you can direct up to $108,000 this way. The thing most people miss is that writing a normal check after taking your RMD still leaves the income on your return. A QCD skips that. Keep it direct. IRA to charity. Ask your custodian for their QCD process and get receipts for your records. Next, HSA timing if you're eligible. HSAs are off limits once you enroll in any part of Medicare, but if you're pre-Medicare or have a younger spouse with HSA coverage, max contributions while you can. Contributions reduce AGI. Later, time tax-free HSA withdrawals to pay Medicare premiums, copays, or dental and vision expenses. That's not lowering MAGI in the Medicare years directly, but front-loading contributions before enrollment gives you tax-free healthcare cash, so you take fewer taxable withdrawals later. Tax loss harvesting is your offset lever. If you have realized gains or expect mutual fund distributions, harvest losses in taxable accounts to offset them. Stay mindful of the wash sale rule. Avoid buying substantially identical securities within 30 days before or after you sell at a loss. Use similar, not identical, replacements to keep market exposure. This doesn't change IRA income, but it can keep overall AGI from creeping up due to capital gains you didn't plan for. Roth conversions still belong, just in smaller bites. Earlier, we warned against one big conversion that blows a tear. The smarter approach is bracket filling. Convert only up to your MAGI cap, threshold minus cushion. Repeat annually. You reduce future RMDs, future AGI, and you build a tax-free bucket that won't move MAGI when you tap it later. If you're already on Medicare, run a quick projection before converting. If you're under IRMAA now, keep the conversion small enough to stay there. Business expense hygiene. For side income matters more than people think. If you consult part-time, document ordinary and necessary expenses cleanly, mileage logs, software, professional dues. Legitimate deductions reduce AGI dollar for dollar. Don't invent. Just capture what you were going to spend anyway and keep the paperwork tidy. RMD coordination is a big one. Don't stack conversions with RMDs in the same year by accident. Remember, you must take the RMD first from traditional IRAs before any conversion of those dollars. Better yet, smooth RMDs across the year, monthly or quarterly, so you can monitor your MAGI drift and pause other moves if you're nearing a cliff. If you give to charity, satisfy a chunk of the RMD via QCDs to keep AGI quiet. Sequence withdrawals with MAGI in mind. When you're near your cap late in the year, cover cash needs from taxable accounts with high basis or from your Roth instead of piling more ordinary income onto AGI. In early years, spend down taxable to reduce future dividends, which lowers baseline income in later Medicare years. The quieter your automatic income, the easier it is to keep under thresholds. Mind year-end fund distributions. In Q4, many mutual funds publish estimates. If your fund shows a large capital gain distribution, consider harvesting losses, swapping into a similar fund before the record date, or pausing other elective income. Don't let a surprise distribution nudge you $1 over the line. Use deductions wisely, but know the limits. Itemized deductions reduce taxable income, not MAGI directly. QCDs lower MAGI because the distribution never lands in AGI. Donor-advised fund contributions can be great for taxes in a high-income year, but they don't change MAGI unless they alter your withdrawal behavior. Pair them with sequencing, so you don't need as much taxable cash. Common mistakes to avoid: sending a QCD reimbursement to yourself instead of directly to charity, converting before taking your RMD, ignoring wash sale rules when harvesting losses, and assuming standard deductions help IRMAA. They don't. IRMAA uses MAGI before deductions. Let me give you a quick 60-second checklist. Am I 71.5 plus and giving to charity? Use QCDs for part of my RMD. On Medicare and converting? Fill only to my MAGI cap. Have gains coming? Harvest losses, avoid wash sales. Near my cap in Q4, spend taxable high basis or Roth, not more IRA. Consulting income? Tighten legitimate expense records. Big fund distributions? Check estimates. Adjust before record dates. RMD plan? Smooth over the year and pair with QCDs. If you remember nothing else, keep income quiet, spread elective moves, and let QCDs do the heavy lifting when you give. Once these levers are in place, you don't fight IRMAA every December. You glide under it. Fix it fast. If IRMAA already hit Pillar 8, if the letter already landed and your premium jumped, don't panic. Treat this like a cleanup with 3 passes. Verify, appeal if eligible, then stabilize cash flow and plan the drop-off. First, verify the notice and your tier. Pull the IRMAA letter and confirm the tax year. Social Security used. Remember, it's the return from 2 years prior. Now, open that tax return. Write down your AGI from Form 104 line 11 and add any tax-exempt interest from line 2A. That total is the Medicare MAGI they use. Compare it to the current IRMAA brackets for your filing status. If the number and status match the tier on your letter, the math likely checks out. If something's off, wrong filing status, missing amended return, or you settled a tax issue that lowered income, put a pin in that. You'll ask SSA how they calculated MAGI and which IRS record they pulled. Next, decide if you qualify for the reset. If your income dropped because of a qualifying life-changing event, retirement or work reduction, divorce or annulment, death of a spouse, loss of pension income, or loss of income-producing property, file Form SSA-44. On the form, check the event, enter the date, and give your estimated MAGI for the event year, and, if requested, the next year. Keep estimates realistic. Attach proof. Retirement or termination letter, recent and prior pay stubs showing reduced pay, divorce decree, death certificate, pension reduction notice, or documentation of involuntary property income loss. Submit it online through SSA's portal or at your local office. If approved, IRMAA drops for Part B, and Part D going forward, sometimes the very next bill. What if your hit came from a one-time spike that isn't appeal eligible, like a large conversion, a home sale, or a mutual fund distribution? The fast fix is to contain the damage and set the slide. IRMAA recalculates every year. If the spike was in 2024, you're paying higher premiums in 2026. Keep 2025 MAGI under the threshold, and 2027 can fall back to standard. That means avoid stacking income this year. split elective moves across December and January, and use QCDs if you're 71.5 plus to satisfy part of your RMD without raising AGI. Your job is to make this a one-year Medicare problem, not two. If SSA denies your SSA-44, don't stop. Ask for reconsideration. Clarify the qualifying event category and tighten documentation. Many denials are paperwork issues, not policy issues. Keep a log, dates, who you spoke with, what you submitted, and any new evidence. If you filed an amended tax return for the IRMAA year, say the IRS data SSA used was wrong, send the IRS transcript or proof of amendment and request they recalculate. Many denials are simply paperwork issues, not policy rejections. Resubmit with clearer documentation, and you often win on reconsideration. The point is simple. Be persistent, be precise, and put your evidence in order. While you work the reset, stabilize cash flow. Higher premiums are usually deducted from your Social Security benefit. If you're direct billed for Part B, update withholding or set aside a small monthly reserve so you don't get late fees. If the surcharge strains your budget, temporarily switch spending to taxable cash or Roth withdrawals so you aren't forced into extra IRA income that risks next year's bracket. A calm month beats a rushed, taxable withdrawal that creates the next spike. Call SSA and ask exactly how they calculated your MAGI and which IRS record they used. Confirm filing status, the tax year, and whether an amended return has posted. If the IRS data is stale, note the timelines and set a reminder to call back. You want the same numbers everyone is using. Set 2 reminders now. First, the fall-off date, 12 months after the IRMAA year begins. Medicare rechecks with the latest available return. If your next return is under the threshold, your premiums can drop automatically. Second, a September and a November checkpoint for this tax year. In September, update your year-to-date income and projected fund distributions. In November, lock optional moves unless you've confirmed a safe cushion. Let me give you a quick micro-plan you can run in an hour. Verify. Rebuild MAGI from your return and match it to the letters tier. Decide. If a qualifying event caused the drop, complete SSA-44 with proof. Contain. If it's a one-time spike, freeze elective income, plan QCDs, and split any remaining moves over December/January. Clarify. Call SSA to confirm the tax year, filing status, and the IRS records used. Budget. Adjust withholding or set a small monthly reserve to cover the temporary surcharge. Calendar. Add reminders for the annual reset and 2 Q4 income checkpoints. Quick mistakes to avoid. Assuming deductions will lower IRMAA. IRMAA uses MAGI before most deductions, converting before you take your RMD, ignoring tax-exempt interest, landing right on a bracket line, and waiting until December 30th to react. A few small moves now are cheaper than 12 months of higher premiums. This is fixable. Either you qualify for the reset and file the form, or you manage the slope so the next letter resets you to standard. In both cases, your power is timing, documentation, and clean income design. Once you've stopped the bleeding, the next move is to design income so you never clip a cliff again. Avoid the cliffs. Tier-aware income design. Now that you've cleaned up the immediate hit, let's design your income so you rarely even approach a cliff. Think of this as driving with lane markers. You'll map the tiers, build buffers, coordinate as a household, and sequence withdrawals so your MAGI stays quiet year after year. Start with tier mapping. Write the current IRMAA thresholds for your filing status at the top of a page. Beneath each, note your cap, threshold minus your cushion, at least $2,000, more if you're variable. Then list every recurring and elective source of income: Social Security, pensions, RMDs, dividends, interest, rentals, side work, conversions, sales, and one-offs. add a simple no-fly label next to anything that would push you past your cap if you executed it in Q4 without offsets. The $1 problem means we never aim for the line. Your target is under the cap with room to spare. If your projected MAGI is flirting with the tier, you're not done planning. Trim, delay, or offset until you're safely inside the lane. For married planning, treat the household like one income engine. Joint thresholds are wider, but they can vanish overnight if filing status changes. Coordinate moves. Which spouse takes IRA withdrawals? Who does the Roth conversion? If one spouse has the higher traditional IRA balance, consider drawing proportionally more from that account early in the year while tracking how it moves your combined MAGI. Keep a survivor scenario in mind. If one spouse dies, the survivor faces single thresholds. Future-proof by building larger buffers now and steadily shifting money to Roth so survivor income is quieter. Sequence withdrawals intentionally. Early in retirement, lean on taxable accounts first, especially high basis holdings, to reduce future dividends and interest that lowers your baseline MAGI for the Medicare years. Once RMDs start, satisfy them, but don't stack a conversion on top unless you've confirmed you'll stay under the cap. When you're near the cap late in the year, cover spending from Roth or taxable cash instead of adding ordinary income. Use Roth as your pressure valve. It delivers cash without touching MAGI. Shift capital gains into lower income years. If you expect a big gain, split across December and January to straddle 2 tax years. If your portfolio is heavy in mutual funds, watch the fund company's Q4 distribution estimates. Consider swapping from a fund expecting a large capital gain distribution into a similar, lower distribution fund before the record date. That's not market timing, it's income control. RMD and conversion choreography matters. If you're converting, take your required distribution first, and then convert only up to your cap. Many investors blow tiers by converting before realizing how RMD, dividends, and distributions add up. Solve that with a quarterly MAGI meter. In March, June, September, and November, tally year-to-date ordinary income and realized gains against your cap. If September shows you're tight, pause conversions or pivot to QCDs for gifting. Micro adjustments late in the year save entire premium cycles. Common small levers. Delay an elective IRA, withdrawal into January. Harvest losses to offset gains you didn't plan for. Pull a scheduled consulting invoice into January. For business owners, accelerate legitimate, already planned expenses into December. If you're 71.5 plus, use a QCD to satisfy part of your RMD without raising AGI. Here's a simple household checklist to run every fall. Cap confirmed, threshold minus cushion written in ink. RMD path, monthly or quarterly, not lump sum guesswork. Dividends and fund distributions, estimates checked, swaps considered. Conversions, fill to the cap only or defer to January. Charitable giving, QCDs lined up if eligible. Backup liquidity, Roth and taxable cash ready to avoid taxable withdrawals. A quick story. A couple with steady pensions and Social Security sat $8,000 under the first tier most years. In December, a surprise mutual fund distribution and a small home repair withdrawal pushed them $1,500 over. The fix the next year wasn't heroic. They swapped the fund in October after checking estimates, spread their IRA distributions monthly so they could stop when close to the cap, and moved a planned $3,000 Roth conversion into January. Result: smooth MAGI, no surcharge letter. Now, 2 advanced but practical moves. First, dividend and interest hygiene. If your taxable portfolio throws off more income than you need, consider gradually rotating into tax-efficient vehicles. Index ETFs with low distributions, individual bonds aligned to spending, or municipal bonds if appropriate. Lowering automatic income makes every other decision easier. Second, cash bucket discipline. Keep 6 to 12 months of spending in cash or short-term treasuries. That buffer lets you choose the best account to tap late in the year without forcing taxable income. Finally, document your tier. Guardrails on one page, filing status and thresholds. Household cap. Quarterly checkpoint dates. Default sequence by month, taxable first, then IRA to cap, Roth for overflow, QCD plan, and custodian process notes. Year-end freeze date. After mid-November, no elective taxable moves without a fresh projection. Do this once, and you'll stop treating IRMAA like a surprise and start treating it like a non-event. Tier-aware design turns cliffs into harmless scenery. And with your income flow smoothed, we can deploy one more stealth move that future-proofs premiums before they ever rise. Future-proofing, Roth without IRMAA shock. The game changer nobody talks about is using Roth conversions to shrink tomorrow's taxable income without tripping today's IRMAA. The trick isn't convert everything. It's convert early in steady bracket-filling bites. And time it so those conversions don't create a Medicare surcharge 2 years later. One more urgency point most people miss. Current tax brackets are scheduled to change in 2026 when parts of the Tax Cuts and Jobs Act expire. If Congress doesn't act, several brackets nudge higher. Think the 24% bracket moving to 25%, and similar shifts elsewhere. That means conversions you make now can be taxed at lower rates than the same conversions after 2025. In plain English, if you're going to convert, the window before 2026 is especially valuable. Act before rates go up. Start with timing. The cleanest window is the gap between retiring and enrolling in Medicare. If you stop full-time work at 62 and start Medicare at 65, or 65 plus a few months, you often have 2 to 3 low-income years. That's prime time to convert, because those dollars won't show up in any Medicare lookback while you're not yet in the system. You're trading a known tax today for lower required minimum distributions later, and lower MAGI for the years Medicare actually cares about. Next is bracket filling. Instead of choosing a conversion number first, choose a tax ceiling and a Medicare ceiling. Write your target bracket top, and if you're already on Medicare, your IRMAA cap, threshold minus cushion. Convert only up to the lower of those two limits. That's how you avoid flipping a larger tax when into a premium loss 2 years from now. Small, repeatable conversions beat the one-time, big push almost every time. Annual, steady conversions work because they flatten your future. Each year you convert a slice, you reduce future RMDs, which lowers AGI in your 70s and 80s. That means fewer IRMAA letters later. It also builds a Roth bucket you can tap for big expenses without moving MAGI. Roof, car, dental work, grandkid gifts. Roth withdrawals don't raise the number Medicare uses. Before we continue, you need to understand sequencing with RMDs. Once RMDs begin, you must take the RMD before converting any additional IRA dollars. That means your conversion room shrinks as RMDs grow. All the more reason to convert earlier when you control the size. If you're already at RMD age, you can still convert. Just keep the total ordinary income, RMD plus conversion, under your IRMAA cap. Watch your Social Security start date. Stacking new Social Security benefits and conversions in the same year can push MAGI higher than you expect. A common move is to delay Social Security a bit while you convert, then start benefits after your main conversion phase. That spreads income and keeps you below cliffs. If you've already started Social Security, you can still convert, just drop the amount to fit under your cap. Here's a simple 2-path model you can sketch in 5 minutes. Path A, quick conversion. You convert a large sum in 1 or 2 years. Path B, slow and steady. You convert smaller amounts over 5 to 8 years. On a notepad, list for each path: tax paid in conversion years, projected RMDs at 73 plus, smaller under Path B, estimated MAGI and Medicare years, and IRMAA exposure. In most real cases, Path B wins on predictability, lifetime taxes, and premium stability. The reason is simple: you're removing the spikes that trigger the 2-year lookback penalties. Now, if you're 63 or 64 and Medicare is near, remember the lag. A conversion you do at 64 affects premiums at 66. If you'll be on Medicare by then, size the conversion to stay under the threshold with cushion. If you're 61 or 62, that same conversion won't touch Medicare. Use those years aggressively, but sensibly. Documentation helps if Social Security ever asks how your income dipped. Keep a 1-page conversion log. Date, amount, target cap, and why you chose the figure, e.g., filled to top of 22% bracket while staying $3,000 under IRMAA threshold. It's not required, but it shows intent and makes it easier to repeat the process annually. Let me show you exactly how to operationalize this. Define your tax bracket ceiling for the year. If on Medicare, set your IRMAA cap, threshold minus at least $2,000. Compute headroom, the lower of bracket space or cap space. Convert only up to that headroom after considering dividends, interest, RMDs, and any other ordinary income. Recheck in September. If dividends or fund distributions run hot, trim the planned Q4 conversion. If they're light, you may safely top up. Common pitfalls to avoid: converting before taking the RMD, ignoring tax-exempt interest when sizing a conversion, stacking conversions with large December mutual fund distributions, landing on the IRMAA line instead of staying under it, converting once in a giant chunk because rates are low, then paying for it in premiums 2 years later. A micro story: a couple retired at 64 with modest pensions. They delayed Social Security to 67 and converted $35,000 per year for 3 years, each time staying $4,000 under the IRMAA threshold. At 67, they started Social Security and reduced conversions to $10,000 for 2 more years. Result: smaller RMDs at 73, steady MAGI below cliffs, no surcharge letters, and a Roth reserve they can use for surprise medical costs without touching premiums. If you remember nothing else, conversions are a future-proofing tool, not a race. Convert earlier when you can, size to your cap, and adjust each fall. Do that for a few seasons and your Medicare years get quieter, fewer RMDs, fewer surprises, and income you control. That calm is the point. Rapid wins. Myths, Q&A, stories, action. Let's clear the fog fast with 4 myths I hear all the time. Myth 1. IRMAA is a tax. It feels like one, but it's not. It's a premium surcharge based on your Medicare MAGI from 2 years ago. You don't file it. You pay it in your monthly Part B bill and as an add-on to Part D. Myth 2. Part D doesn't matter. It does. The same income brackets apply to both Part B and Part D. Cross a tier, and you often get hit twice: doctor coverage and prescriptions. Myth 3. SSA-44 works for capital gains and Roth conversions. It doesn't. SSA-44 is for qualifying life-changing events like retirement, reduced work, divorce, death of a spouse, loss of pension income, or loss of income-producing property. Investment choices aren't qualifying events. Myth 4. Appeals never work. They work when the event and documentation are right. If your income truly dropped due to a qualifying event, SSA can reduce or remove IRMAA going forward. The mistake is sloppy estimates or missing proof. Now, quick mistakes I see weekly: big December conversions with no cushion, ignoring Part D, so the total hit is underestimated. Pair planning, miss, spouses making separate moves that collectively cross the cliff, and forgetting tax-exempt interest gets added back to AGI. For IRMAA, Rapid-fire Q&A time. Will IRMAA auto-expire? Yes. Each year, SSA rechecks with the latest IRS data. If your MAGI falls below a threshold, your next year's premiums can drop automatically. Can part-time work qualify for SSA-44? Only if it's a documented work reduction that lowers income, not just a side gig starting or stopping. You need proof of reduced earnings. We file jointly. Do both of us pay IRMAA? Yes, surcharges apply per person. Joint income is measured against joint thresholds, and each spouse gets their own Part B and Part D add-on. How long does an SSA-44 decision take? It varies. Submitting clean documentation helps. Some approvals show up in the next billing cycle. Others take longer depending on workload. Do QCDs lower MAGI? Yes. A qualified charitable distribution from your IRA counts toward your RMD, but never hits AGI, which is exactly why it lowers Medicare MAGI. What if I move states? IRMAA is federal. States don't change the surcharge math, though taxes and plan choices may differ. Can I appeal if I filed an amended return? Yes. If SSA used an IRS record that's now outdated, provide proof of the amendment and ask them to recalculate. Let me give you 3 micro-stories to make this real. A teacher retired in June. Her 2 years ago MAGI was high from a final payout. She filed SSA-44 with the retirement letter, a year-to-date stub, and a realistic MAGI estimate. Result: IRMAA removed going forward for both Part B and Part D. A couple with steady pensions sat $300 over the first tier after a surprise fund distribution. They swapped the fund the next year after checking estimates, used monthly RMDs to watch their progress, and moved a small Roth conversion into January. No surcharge letter the following cycle. An investor harvested losses in November to offset hot mutual fund gains, then used a $6,000 QCD to satisfy part of the RMD without raising AGI. They ended the year $1,800 under the cap and avoided both Part B and Part D add-ons. Now your 15-minute action plan, fast and specific. Step 1, write your cap for this year. Take the current threshold for your filing status and subtract at least a $2,000 cushion. Step 2, rebuild projected MAGI. AGI line 11 plus tax-exempt interest line 2A. Add year-to-date distributions, dividends, and any known capital gains. Step 3, pick one trim move. Delay income into January, reduce a planned IRA withdrawal harvest losses, or if you're 71.5 plus, schedule a QCD. Step 4, if you had a qualifying life change, download SSA-44, list the event, date it, estimate your MAGI conservatively, and gather proof. Submit it now rather than waiting. Step 5, set 2 reminders, September projection check and November lock. After mid-November, avoid elective taxable moves unless a fresh projection says you're safe. Let's be honest, we've all had the just a little more in December moment. The fix isn't heroics. It's buffers, checkpoints, and clean paperwork. If you remember nothing else, remember this. Under the line is a plan. On the line is a gamble. One last nudge. Pull last year's return tonight. Add line 11 to 2A and write your cap on a sticky note where you'll see it. Then pick one lever, QCD, delay, harvest, or reduce, and schedule it. Small moves now beat 2 years of surprise bills later. Your 15-minute IRMAA action plan. Let's turn everything into action. Set a 15-minute timer and follow me step by step. Step 1, write your cap. Grab a sheet and write the IRMAA base threshold for your filing status. Now subtract a $2,000 cushion. That number is your MAGI cap for this year. Under is a plan. On the line is a gamble. Step 2, rebuild your MAGI. From last year's return, Note Form 104 line 11, AGI, and line 2, a tax-exempt interest. Add them. That's the Medicare MAGI calculation. Now draft this year's estimate using year-to-date pay, pensions, Social Security, IRA withdrawals, dividends, interest, and realized capital gains. If you're unsure on fund distributions, mark a task to check your fund company's Q4 estimates. Step 3. Measure your gap. Subtract your projected MAGI from your cap. If your gap is negative, you're over, time to adjust. If it's under $5,000, you're too close, build more room. Step 4. Pick one MAGI trim move you can do this week. Choices: delay, push an elective IRA withdrawal or consulting invoice into January. Reduce, cut a planned Roth conversion or withdrawal to fit under the cap. Offset, harvest capital losses to neutralize gains. Watch wash sale rules. Replace, cover cash needs from taxable high basis or Roth instead of IRA. Give smarter if you're 70 and a half or older, and give anyway. Initiate a QCD to satisfy RMD without raising AGI. Step 5. Install your 2 checkpoints. Add calendar alerts for September 15th, projection check, and November 15th, lock. In September, refresh dividends, distribution estimates, and realized gains. In November, freeze elective taxable moves unless a fresh projection confirms buffer. Step 6. Map your 3-year view. Draw 3 columns. This year, tax year, next year, and Medicare year affected. Under this year, list the moves you can still shape. Under next year, list moves to split into January. In the Medicare column, write which premiums each tax year will influence due to the 2-year look back. This prevents you from fixing the wrong year. Step 7. RMD choreography. If you're at RMD age, decide your draw pattern now, monthly or quarterly, so you can monitor drift and pause elective income if you're nearing the cap. If you give to charity, plan QCDs to cover part of the RMD without touching MAGI. Step 8. If a qualifying life change lowered income, start SSA-44 today. Check the event box, date it, estimate your MAGI realistically, and attach proof: retirement letter, pay stubs showing reduced pay, divorce decree, death certificate, pension reduction. Submit online or at your local office. Mark a follow-up reminder in 4 weeks. Step 9. Create a 1-page guardrail sheet. List filing status, current thresholds, and your cap, year-to-date ordinary income and realized gains, plan conversions and their ceiling, RMD plan and QCD targets, fund distribution estimates with record dates, your freeze date after mid-November. Step 10. Household sync if married. Share the cap and current gap. Coordinate who takes which withdrawal, how much Roth conversion fits, and what gets delayed. Add a survivor scenario note. If filing status changes, buffers shrink. Agree now to keep extra space this year. Step 11. Portfolio hygiene quick pass. In taxable accounts, scan for loss positions to bank against gains. Note any mutual funds projecting big distributions and consider swapping into more tax-efficient funds before the record date. If your automatic dividends and interest exceed what you spend, begin a slow rotation toward more tax-efficient holdings to quiet baseline MAGI next year. Step 12. Liquidity cushion. Confirm 6 to 12 months of spending in cash or short treasuries. That buffer lets you choose the best account to tap late in the year without adding taxable income. Step 13. 5-minute audit of common misses. Did you count tax-exempt interest? Did you plan conversions after taking the RMD? Are you trying to land on the line instead of under? Do you have a QCD set up if you're eligible? Are December and January split options on your radar for any large sale? Step 14. Commit one action before the timer ends. Email your custodian for a QCD packet. Move a planned withdrawal to January on your calendar, request distribution estimates from your fund companies, or cut your intended conversion by a specific amount. One small move now prevents 12 months of bigger bills later. Step 15, close the loop. Put your guardrail sheet where you'll see it. Add the 2 checkpoints and write a sticky note. Under is a plan. That's your 15 minutes. You now have a cap, a projection, a cushion, a move for this week, and 2 checkpoints to keep you honest. The conveyor belt is predictable. Your job is keeping your year boring. The key takeaway: IRMAA punishes spikes, not steady plans. Smooth income, keep a cushion, and use QCDs and timing to stay under the line. Want the next step? Download the free checklist, link below, to run your 15-minute plan. Then watch my RMD timing deep dive to coordinate conversions without tripping IRMAA. Subscribe for weekly senior money and health traps so you never get blindsided again. 5 minutes today beats 2 years of surprise bills.